um, I do want to point out that contrary to what a lot of people was thinking here, crude oil is now down 2.7% in the aftermarket. And on top of that, we have the NASDAQ and the Russell 2000 currently in the green. You know, in the spirit of how to trade and invest, let's discuss this a little bit here, right? Um, the the risk that we were facing, right? And again, you can check my screen out. I'm showing my screen right now, so you can take a look at what we're talking about. All right, so the risk that you were facing, right, in the market. Um, One of the first things as a trader that you should have done, that you want to do in moments like this, is determine: am I dealing with a long term or a short term catalyst? Am I dealing with a long term or a short term issue that's going to be, playing out in the market? And I know that a lot of people believe that this is going to be a long term issue. And I'm not telling you that it's not going to be a long term issue. But what I am saying to you is what I am saying. I'm saying to you that you need to let um, the actual trends that have already proven themselves, let those guide your actions. And so people, far too often, people see things happening in the market and they didn't get a chance to respond when it first happened, right? But they see what's going on now, and they're thinking to themselves, "I want in on that," right? So let's talk crude oil for a second, right? I'm going to go to the monthly chart for crude oil. I just want to know, what do you guys notice about crude oil? This is the monthly chart now. Please notice this is the monthly chart. So what is the first thing you notice here? You'll notice that crude oil, since 2008, has been in a long-term structural downshift, right? Until around 2020, when it dropped so low that that just gave the market an actual boost. Because I mean, when something's that cheap, the demand is gonna come in strong again. So notice what I just said there, right? So again, when I see crude oil that low, I ask myself, how long will it be that low? Like, sure, crude oil was in a long-term structural downtrend, but I doubt they were going to -20 with that. Okay, I doubt they were going to zero with that. Crude oil will never be worth $0. Let's be clear about that part. All right, crude oil will never be worth $0. I mean, not in the history of our nation has anything suggested crude oil is going to $0. When that time comes, right? Maybe we'll figure something out, right? But for now, and even in the long run, when we have like other things going on, when the grid is more electrified and less ran on fossil fuels, even at that point, crude oil likely will not go to zero, because when it's all said and done, um, the economy still needs, like, okay, does anybody think we're going to get rid of plastic forever? Does anybody think plastic is going forever at any point in time? Anyone? Plastic. Does anyone think plastic is going forever? No. Okay. So in that regard, you have to have oils to make plastic. You can't make plastic without them. Right? So that's one thing right there. Um, lubricants for rubber parts. All right. That's going to be another difficult one there. All right. The lubricants for rubber parts that you put in planes and trains and trucks and electronics and so on and so forth. You need lubricants to make sure that those are playing out well. Either way, my point is crude oil was on the way down, but I thought it was going to zero. So when it hit this low down here, I bought immediately because there's nothing that you're going to tell me that's going to get me to believe that it's going to stay down here in over the long run. I also bought down here because at that point in time, we were already prepared to throw stimulus at the economy. Right? Again, supply and demand, right? So in this moment, we had an oversupply, drove oil prices so low that any amount of demand would have moved the oil prices back to the upside, right? Around this time right here, I remember people saying, "Oh, crude oil is done. It's all solar now. Um, it's all solar now. It's all what do you call it? Uh, it's all wind energy and so on and so forth, right? And let's just say renewables in general. Um, they were more wrong about that than anything I've ever seen in my history of operating in the markets. Now, the next thing I want to look at here, so let's go back to what we were talking about, is where we are right now. All right. So generally, um, if you look at the history of crude oil, um, every spike in crude oil comes from somewhere, and after that spike in crude oil, you usually see a return to more of a base level, right? Yes, of course, we would love to see crude oil stay at these prices if we're energy companies, right? You would love to see that if you're an energy company. But in the long run, the demand for crude oil will diminish because the economy will shrink. Right? It goes back to like what some of us talked about today when we were what some of us watched today when we were on our stream. Um, like when Maryland tried to solve their problems by taxing the rich. Right? It worked for 1 year, but what ended up happening? Right? The rich just ended up leaving. Right? So um, supply issues tend to be, you know, resolved pretty easily by just decreasing the production. Right? Um, demand issues are a little harder to fix. So these guys wouldn't want to see the demand for their products start to drop off because that usually means that there's a bigger problem than high oil prices, and that problem usually is a slowing economy. So when it's all said and done, I think that was one of the first things that clued me into some potential upside. Um, now, if we talk about the downside, now that's this is just potential upside in the market, right? Now, if we look at the market itself in general, let's go to the actual market itself. Let's go to the NASDAQ. Let's go to the weekly chart instead. Now, we're not going to talk all charts here. Let's talk business. right? Right here, you see I have the actual performance by sectors and whatnot. You can see that large cap growth and mid cap growth were the best performing on the day, right? Now, large caps in general were also very good performers on the day. Let's take a look at something here, as I want to show you what we had going on here. Let's go to markets. Let's go to market fair value. We're going to go to large caps. We're going to start with large caps, right? So large caps, still after that entire rally that we just saw, the large caps were actually trading 10% below fair value um, at the close of the day. Now, where were they around March? March 31st, the day that the market spiked, 16.5% undervalued in large caps. Let me break something down for y'all real quick, and you're gonna want to write this math down because this math may change your life one day. Okay, anything over 15%. All right, if you have a 15% return, right? Let me show you guys something here. Okay, if you have a 15% return on something or return expectation, that 15% return expectations means that I could double my money over a 5-year period. Okay. In the world of finance, um, you know, that 100% return is very elusive. All right. A double up of your money is not happening every day. All right. So not every investment you make is going to do that. But the investments that you make at 15% or more below fair value, all right? And if you do that on a consistent basis, you're going to be doubling and tripling your money. I repeat, if you do that on a regular basis, you're going to be doubling and tripling your money. Okay? That's how that works. I'll show you the math. If you're not watching right now, again, you can click where it says link in bio at the top, right? The at D1 Finance. And you click that link and you see it says watch us on Twitch. I'm about to show the math right now. Let me show you the math. Okay? Let's go on over here. We're just gonna pull up a nice I can just bring out a plain balance sheet, a spreadsheet, and just get the work done, right? So this is today. All right, let's go and get this out of the way here. This is today. All right. This is 1 year from now. This is 2 years from now. 3 years. All right, 4 years. And 5. Okay. Let me show you how this works. Let's say you have $1,000 right now. Okay. Y'all know what I do. I'm not just gonna tell you and expect you to believe me. I'm gonna show you. Right? That's how it should be done. So let's say you have $1,000. Okay, you got 1,000 right there. Let's make sure all these are in dollars as well. Boom. So now if I take that $1,000 and I add so that $1,000 plus 15%. All right. 1 second here. So we're gonna say times. This is why they do times, right? So times 1.15. That'll give you 15% there. All right. That's $1,150. Okay. If I shift that to the left here, if by 2 years from now, if I keep doing that 15%, if I keep getting 15%, I'm at $1,300. You see in the math right here. Let me zoom in for you. All right. Let me zoom in for you. Here. Let me zoom in for you. Make sure you can really see it. 200%. There you go. Okay. If I move that to another year, I'm now at $1,500 at 3 years. Okay. So again, if I can keep investing, if I can keep investing and getting a 15% return, this is what's going to happen. Let's go to year 4. By year 4, I have $1,749. And guess what? As promised, by year 5, I have $2,011.36. Okay? That's how this game works. So we're talking the lowest point. I'm gonna go over here. Let's go to the chart. I'm gonna go to the daily chart. We're gonna see right now, right? On Monday, the 30th of March, 2026, you see that. That was the lowest point of this most recent drop in the market. And at that same time, the largest companies in the stock market were undervalued by 16%. So what did I just say? What I'm telling you is you were staring a wonderful opportunity dead in the eyes. And either you knew that or you didn't. Now, if you show up to these rooms and sessions on a regular basis, you will know who teach you. Or you would have known because you would have heard us say it. Right? Now, watch this. Let's go to the tech sector. So one of the key things we identified was that the tech sector, the technology sector, for the first time in a long time, was deeply undervalued. All right, let's go to the tech sector. Here we go. So while the largest companies in the market were undervalued by about 15%, the tech sector was undervalued by 26.8%. Okay, this according to market Morningstar, their market fair value. All right. Um, but nonetheless, staring a great opportunity in the face. So again, you have to ask yourself, so how long was this supposed to last? How long was it supposed to last? So you can see here, you already had drawdowns below 10% twice this year. Twice in the past 6 months, let's just say 6 months. Yeah, right, twice in the past 6 months. One on November, right, 20th, 2025. Then the other in December 17th, 2025. Okay? And then the market pushed to fair value 2 times and found resistance there. And then you started to, start to see some leaking going on there. You finally broke that 10% range in February. Then things started to get ugly after that once the war came about. And I think, before this started to happen, before this happened, yes, you did have some overvaluation going on in the tech sector, but that was being dealt with before the war came about. And then the war came and sped that process up. And so, great. Great. Now we get to take advantage of some things. Let's take a look at the defensive sector, right? For the past year, we've been overly allocated, right? So at the same time in February, right before the war kicked off, we were already 20% overvalued in defensive names. This is consumer defensive, by the way, not defense like Raytheon, Lockheed Martin. We're talking Walmart, Costco, so on and so forth. So we were already starting to position for the potential that we needed some protection in the market. You could have seen these things happening. Okay. Let's go to industrials. Look at that. Same thing, right? 15% overvalued. So when we were selling off the tech names, we were buying industrials, we were buying consumer staples, right? What else were we buying? Right? Healthcare was not as overvalued, and we still need to pay attention to healthcare, guys. There's a lot of opportunities there, that you want to pick up on. We saw the same thing when we were coming into the year, and that, that's been helpful as well. Um, Utilities has been another one that we've been piled into. You can see that utilities has not spent not one period below fair value in the past year. That's because of with all the data center infrastructure and all that stuff coming about, right? With all the data centers being built out, utilities companies are like the new growth right now. Don't get too caught up in it. Eventually, reality will set in, and people will realize that every utility company is not gonna have the same results, right? We know energy took off this year. You can see it went from being undervalued to almost 20% for themselves, 18% there. By the way, what's up, Corey? What's up, Fo5? What's up, Renee? Long time no see, Renee. What's up? What's up? Smithsonian. What's going on? Maisa, Wole, Roxanne, Chigozi, Riza. What's going on, guys? Hope everybody's doing well. What's up, Dish? Hola, hola. So yeah, so you can see how that was playing out. So then the question at the moment, right? The question at the moment was, how long was the downside supposed to last? That's the question, right? We saw companies like Microsoft. All right, let's go to Microsoft real quick here. All right, let's go to Microsoft. By the way, look at that pullback off of the closing target at the close today. Isn't that amazing, y'all? That's crazy. So we did not get to close above the closing target today, but we did close above the true high. We got that done. Now tomorrow, look at SPY looking strong at the close. All right. So tomorrow we'll have to, you know, see if SPY can get a close above their true high, and then maybe, just maybe, I think that means we'll be going on to test the all-time highs. So y'all know what we got up here, right? What do we got up here? Liquidity, right? Of what sort? That's the question. Do we have nothing but sellers waiting up here, or do we have so remember, so when it comes down to liquidity, right? People think negatively about liquidity because what they're taught, right? All the retail traders and retail investors are taught, oh yeah, if your liquidity, this and that, right? Like we have that kind of conversation with each other. But the reality is, liquidity isn't only something that works against the market. Sometimes it works in favor of the market. So there's all kinds of liquidity that can be waiting above this high. I'll give you an example, right? So there can be people waiting up here saying, hey man, I dodged a bullet. I dodged a bullet. If we get back to that high, I'm about to sell all the stocks I didn't get to sell before Donald Trump opened his mouth. Right? Okay, so you can have those types of people waiting up there, and there could be a lot of them. Right? Or, or, right? You could have a lot of individuals who didn't think we would get back this high. All right. Short and guys that are short the market. And they're saying, hey man, if we break that high, I'm out. I'm done. I'm done with my short. I'm not playing with this game. I'm not playing no more. I'm done. Right? So they break this point right here. By the way, if they break this true high, you might get that point. This 688.62. They break that, you might get that moment. But let's just stick with the highs for example for a second, right? So that might be the case, right? A lot of short sellers who are now like, I got to get up out of here. There's no way I can take any more bleeding. So that's very possible. So you see, there's then there's also the limit buyers as well. The ones who said, if we break that high, I want in. So imagine if the limit buys, right? Imagine if those meet up with the short sellers who want to get out. That could be a powerful move, right? If there's enough of both parties up there, right? Then of course there can be limit sellers up there as well, right? To meet up with the ones who want to just get the heck out because they, whew, breath of fresh air, a second chance to get rid of the stocks they should have gotten rid of, probably last year, you know. Um, and let's not forget about these guys who are piled in. So we call these crowded trades, is what we call them. They're called crowded trades, right? And all you have to do is look at the stock. You can tell it's crowded. Right? Pull up Micron. Oh, that's not Micron. All right, pull up Micron right here. All right. See this? Trust me, it's a little crowded in there, but who are we to judge? Right? It's over when it's actually over, not when we say it's over, right? So we play the game. Play the game however it's meant to be played. Right? Plain and simple. We don't try to predict every single move of the market. Right? We go with logic. What's logic? What's the logical move here? And I mean, right now, logic is suggesting that we might be testing those highs again. Right? Um, at least for the sake of seeing some of these tech names, stretch their feet a little bit. I stretch their legs a little bit. All right. Now, so everything in my opinion suggested that this downturn was going to last very long. So I waited and I watched for the moments where the stocks that I wanted to buy were trading at, not just at a discount, but also at levels that suggested that the bounce was on the way. How do you do that? All right. How do you do that? Let's talk about it. For those that are just joining us, I'm about to show what I'm talking about right now. If you want to come on over, you can check my screen out. I'm sharing my screen right now. You click the link at the top of the room at D1 Finance. You click that link and you will see it says watch us on Twitch. All right. See it says watch us on Twitch. Feel free to slide on over. Also, you'll see it says the playbook for stock investing. Feel free to grab yourself a copy of that as well. We'll be discussing that book on Wednesday and Thursday. All right, let's talk about it. So how do we do that, right? So we know the stock is undervalued. We know it's undervalued, but we need to wait for the right moment to make a move. All right. Now, the tool I'm about to show you guys is something that I built to keep me from having to stare at charts all day. All right. But it involves all the technical factors. One of those technical factors is a thing called standard deviations. All right. Good evening, Brooklyn, David, Rotul. Good evening. All right. So yeah. So one of those things that we utilize is called standard deviation. And standard deviation is actually more simple than it sounds. It may sound all complex and highbrowish and whatnot, but it's not. It's actually pretty simple, right? So how about this, right? So let's say on average it takes you 20 minutes to get to work every day. Okay, let's say on average it takes you 20 minutes to get to work every day. But every once in a while, it could take you a little bit longer. Every once in a while, it could take you a little bit less. Right? But there's going to be an average amount of traffic. There's going to be an average amount of times you hit a red light. There's going to be an average, right? So there's going to be, it's not always going to be smooth sailing, right? And well, that's unless you work from home. And in that particular case, but even in that particular case, it can the time it takes you to get to work, even at home, is going to vary as well. Well, let's stick to you driving to work, right? Or walking, either one, right? It takes you an average amount of time to get there. Now, those times where it takes you a little bit more and a little bit less, those are called deviations, right? Times when you deviated from your average time. So, in standard deviations, you learn what those deviations are, and you start to respond to them. You start to respond to those and react to those, right? So let's say, for example, let's go back to my little handy dandy spreadsheet here. Let's scroll on up. Let's say on average it takes you 30 minutes to get to work.
Balances the interests of our creators, our users, policymakers, parents, all the different constituents that we care about.
Sorry about that. Let's say on average it takes you 30 minutes to get to work, right? 30 minutes. All right. Now, let's say that number. You guys ever heard somebody say give or take a few? When they say that, they're actually talking about standard deviations, whether they know it or not. So if I say, oh yeah, I'll be there in 20 minutes, give or take a few, they're actually talking about standard deviations. Right? It could take a little bit more, it could take a little bit less. Now watch this. So then I say, I'm gonna put give or take just to make it simple, right? So takes you 30 minutes to get to work, give or take 5 minutes. Okay? Give or take 5 minutes. So here's how this works. So this means that on any given day, right? On any given day, the standard amount of time it's going to take you to get to work is going to be somewhere between 25 to 35 minutes. And guess what? There's a what do you call it? There's a percentage attached to that. That percentage is 66%. So 2/3 of the time. All right, we'll say 2/3. Keep it simple. All right. So 2/3 of the time. That's 2/3 of the time, right? So 2 out of 3 days, every 2 out of 3 days is going to take you 25 to 35 minutes to get to work. Okay? Out of the 30-day month, right? Out of the 30-day month, 20 of those 30 days is going to take you 25 to 35 minutes. But every once in a while, you have what's called an anomaly. Right? Or so what do we call this? What do we call this in the working environment? Let's just say you have a bad day or a good day. Right? You're having a really bad or a really good day. That's fair enough. Is that how I should or y'all calling it something else? What are we calling that? All right. What do you call that day when you when nothing is going right and you just know you're going to be late for work, later than usual? What do you call that day? Bad. Corey says an interesting day. You know what? Let's go. We're gonna go with interesting. We're gonna go with interesting. All right. Fine. We'll call it interesting. Every once in a while, you're gonna have an interesting day. I like that one, Corey. We'll go. Yeah, I like interesting. Let's go with interesting. All right. Now here's how this works. On these interesting days, right? What's going to happen is you're going to deviate more than just one times this amount. On these interesting days, you're going to be either extra late or you're going to be extra early. So that typically is going to be between 20 to, so that's 20 minutes. It means you showed up. That means you got to work within 20 minutes, right? Or 40 minutes. All right. So on the days where, you know, you got to work within 20 minutes, it was a good kind of interesting. You know, every green light was just giving you the go. You know what I mean? It was just no stopping. You know, no construction. It seemed like nobody was outside. You woke up this morning and all, and I mean, just everything was just, you know, was just on point. You know, let's say you happen to like to stop to get a cup of coffee in the morning. There was no lines. It was just like, oh, okay, nobody's here today. All right, this everything just worked in your favor, and you got there, you know, within 20 minutes. But let's say on the other side of that, nothing went right. Matter of fact, you woke up and the first thing you did was hit your toe on the bed rail. You know what I'm talking about? One of those days, right? Um, it took forever for the hot water to come on. It you know you popped the button off your shirt. You know everything was going wrong, right? You spilled coffee on yourself on the way out the door. You had to change again. Every red light caught you. Matter of fact, you hit a pothole, caught a flat tire. Everything happened, right? Either way, and well, no, the potholes is for another day. You know, the flat tire is for another day. This is more just the little interesting things, right? But either way you get it, you know. So here's how this works: 95% of your days are going to be between the 20 and 40 minutes. 95% of your days are going to be in this range. Okay? Plain and simple. All right? So now you had 66% of your days, you're going to be normal, 25 to 35 minutes, you're getting to work. On average, it's 30. All right? But on those interesting days, you might be there within 20 minutes, it might take you 40. Then you have, what do you call the other days then? What do you call that day when absolutely positively nothing went right and it took you 45 minutes to get to work? What do you call that one? All right. You know what do they call those? Act of God days. That's what they call them, right? Yeah, these are the days when only God could have made this happen. Only God could have got you to work in 15 minutes. Okay. All right. And maybe he just wanted to have you avoid some of the worst things, and he slowed you down one day too. You know what I mean? There you go. There you go. Maybe he just want to have you avoid. Maybe he just want to have you avoid some of the worst things that could have happened to you if you would have gotten there on time. You know? Who knows? It could have been. It could have been a shootout at work. You know what I mean? It took you 45 minutes to get there that day. Right? It took you 45 minutes to get there. All right. Now, what we say here is 99% of the days are going to be in this range. Okay, 99% of days. That's how this works. So the same thing goes with the stock market. Okay, so when I said that the stocks were trading at a very, very great value, but you're waiting for something to happen that suggests that it's the right time. We're talking about this moment right here, right? The interesting days or the act of God. That's what we talk about, right? So I'm gonna take you over to my other sheet here, and you'll see I have Apple pulled up on my screen. So I'm gonna go to Apple on my chart real quick. And Apple went as low as 245. All right. You can see right here, 245. What is that? That's 2 standard deviations, right? That's 2 standard deviations. So these are your interesting days. All right. So this is the point where, okay, Apple is undervalued and they're trading at a very interesting place where, usually they don't trade down here by this much, right? Not on average. On average, they're 253 or higher. Okay? On average, they're 253 or higher. Today, they're 245. So, I can work with that. All right? Let's go to NVIDIA. While they pull up, let's go to the chart. What was the low for NVIDIA? NVIDIA's low was 164.27. Right? If I come back over here, got it pulled up here. So NVIDIA was where? Again, below the 2 deviations. Y'all think this is a coincidence? It's not. Not a coincidence. Okay? And I can check one stock after another, and I can assure you, look, we're below the second support right here as well, when we're at that price. I can check one stock after the other, and I can show you how these large cap tech names, these large cap tech stocks, were all trading below 2 standard deviations. Now, you can learn more about standard deviations over time. I mean, I teach it all the time if you want to show up on a regular basis, and I'll teach you all about it. You can ask questions. I'll teach you about the calculations and all that extra stuff, get deeper into it. But here's what you can also do. On your chart, you can use an indicator that we call the Bollinger Band. I'm going to be honest with you. I don't use the Bollinger Bands at this point in time. Right? But the Bollinger Band is a very, very neat tool, a very unique tool. Right? It can help you out here. So you can see, so this blue line going through the middle here is your average. This is your 20 period moving average. Okay? The red line over the top, this is 2 standard deviations to the upside. The green line running along the bottom is 2 standard deviations to the downside. Okay? So they're showing you the same thing that I have right here. They're showing you the same thing. All right. What's up, Anthony, Cher, Liz, Prince, Allison, Jay, Sean? What's going on, guys? All right. So they're showing you the same thing. So you can see these moments where NVIDIA hit this 2 standard deviations to the downside. What happened? They bounced back up to the average. Hit 2 down to the downside. They bounced back up to the average, right? They went beyond the average here, of course, but you get the point. 2 to the average, 2 to the average, 2 to the average, 2 to the average, okay? Because that's how this works. They're supposed to be within 1 standard deviation 2/3 of the time. Let me put this to 1 deviation instead of 2. Watch, I'm going to put it to 1. Let's do this now. So now it's at 1 deviation. So notice, right? You have these periods. Look, you have this period right here where they call this riding the band. They call this riding the band. It's pretty interesting, isn't it? They call that riding the band, right? And you're riding the 2 standard deviation band, not the 1, right? But you can see how that actually worked. Pretty dope stuff. But look, right? Look at how much time you spend back inside these bands, right? Look at this. Look at right here. You popped out of the band for a little bit, out of the 1 standard deviation, right back in there, out of the 1 standard deviation, right back in there, right? You're out, you're back in, right? You're out, you're back in, you're out, you're back in. So you're going to spend most of your time, right? Most of your price is going to come in here. So if this wasn't applicable to stocks, then I shouldn't be able to see what I'm seeing right now. Okay? But we generally keep our Bollinger Bands on 2 deviations. And let me teach you guys a trick here.
Were actively trying to spread misinformation.
Why do I keep hitting that button?
Throw them in jail. They're bad people.
Sorry about that. So we usually keep it on 2, but if you want to be extra, with it, you can put it on 3 and only look for moments where it hits the 3rd. Like right here, it hit the 3rd. Right? Boom. Right here, it hit the 3rd. Boom. Right here, it hit the 3rd. Boom. Right? Got close to the 3rd here, didn't quite hit it. Right? Right here, it hit the 3rd. What happened? Boom. Right? So you can put it on the 3rd right here, hit the 3rd. Boom. Okay? So you can look for these moments right here, hit the 3rd, and gone out of there. Okay? Hit the 3rd. I'm just showing you. Hey, listen. Am I skipping any? Y'all see me skipping any of them? No, I'm not skipping any of them. I'm hitting all of them. Right? Boom, to the downside. Hit the 3rd right here. Back to the upside. Okay? Let's see here. Hit the 3rd right here. So this one right here didn't play out. So this one that didn't play out right here. Right? Got to the 3rd here. Downside. So these are, look, 3rd deviation, bounce. But you rolled the 3rd deviation for a little bit first, though. Right? So, in all fairness, this one took a while to play out. But most of them play out as soon as you get down there, then boom. All right? So you're here, then eventually you work your way to the downside here. Either way, you get the point. Right? And let me tell you, when you get these really narrow 3 deviation ranges right here, see how narrow this is? When you get this, let me tell you something. This is coming. I'm not asking you. I'm not saying maybe. I'm guaranteeing you. When you see this 3 deviation narrow like this is coming. 100%. I'm gonna show you guys something else. Watch this. Let me get rid of this for a sec. No, actually, bring that back. Get sorry out of here. Watch this. Keltner channels. All right, now we got 3 deviations on the Keltner channels. I mean, on the Bollinger Bands, we're going to put 3 ATRs on the Keltner channels. Boom, 3 right there. So you see this? Right there. And this moment right here, see your channels right here, right? So these are your watch. Let me move this a little bit. See that? Your channel is usually in between the Bollinger Bands. So when your Bollinger Band pulls back and goes in between the Keltner channels, a wrap. You're out of there, guys. 100%. I'm not. That's not. Again, that's not a maybe. Y'all know me. I don't mind guaranteeing things because, I only talk from an academic perspective. These aren't things These aren't things that I learned on the, only from looking at the internet. Right. I schooled with some of the best programs, and these are things you learn. And these are things that I take pride in teaching to you guys, so that way you guys can get out there and handle your business and get your cake up. We're just trying to make the wealth gap a little bit smaller. You know what I mean? That's all we're trying to do. We just want to close that wealth gap a little bit. Do our part. Everybody else got to do their part. We're gonna do our part, right? So if you're in here tonight, I just want you to double your net worth one time. That's all. That's nothing big. Just double your net worth one time for me, and let them know you're here. That's all I'm saying. Let them know you're present. Okay, so this is the Bollinger Bands. You can use it, as I said. It's telling you the same thing that I'm telling you right now. So imagine Nvidia is undervalued. Let's do this very carefully. Imagine they're undervalued by, I don't know what they were undervalued by at the time. Let's say they're undervalued by I think it was like 36%, something like that, right? And they hit this third deviation. What are we talking about? We need that, right? Let's go to Microsoft. Look at Microsoft, right? Notice, so Microsoft, they hit right here a little bit, right? So when they hit right here, they bounce a little bit, but they still had downside left in them. Like they just still had downside left in them, right? So now they fell and finally hit it again, right around here, this area right here. Now they're getting a bounce. Microsoft is super undervalued at this point in time, right? I also want to point out, you can see here, you see a little divergence here. Yeah, that's right. You can see divergence on the Bollinger Bands as well. See a tiny bit of divergence right here. All right. So that low point on the Bollinger Band didn't reach the same low point as before. Right? Pretty dope, right? You see you can catch divergence almost anywhere, guys. Real talk. All right. Divergence is just one of those things. You love to see it. Anyways, does anybody have any questions about anything I just said? Let me pause for a minute and give y'all some give y'all a chance to maybe ask some questions or something like that. Right? Talk to me. Let me check the stream. Oh, throw the day away. I'm just seeing it on Twitch right now. He said throw the day away. So no questions? All right. So I mean, so let me just let's recap a little bit here, right? Let's recap. And then we can go from there. It's just a bit of recapping. When you see something happen, like what happened with the war in Iran, do not panic. Do not panic. You have to be strategic. And your first goal should be to develop an understanding of where we are in the market. And you should have already known that anyway, but let's say you didn't know. All right? Develop an understanding first. All right? How do you do that? What do you do? All right. First, you look at the asset that's causing the problems. In this particular case, it was crude oil, right? Causing the problems. What do we know about crude oil? It was in a long-term structural downtrend before this. We don't know if that was over with yet. But we do know that crude oil does not tend to sustain the spikes in crude oil for a very long time. So for now, we're under the assumption that crude oil prices, every time they spike, will make the way back to the downside as we try to offset that, right? That price spike with more supply in the market, right? Even Donald Trump was pulling barrels out of the strategic reserves in order to try to get oil prices back down. So, in other words, I guess I'm saying to you, every country in the world will fight tooth and nail to try to bring oil prices back down. Do not listen to your little buddies who have these conspiracy theories. Okay, please don't. Listen to me. I'm trying to tell you the truth here. Okay? This is not a conspiracy against you. Okay? The reality is things happen, right? But if you know economics, like I know economics, what you know is that when something happens that brings oil prices to where they are, nobody wants them to stay there except for maybe the oil companies for a small period of time. But even the oil companies don't want them to stay there. That's true facts. Even the oil companies do not want oil prices to be at these levels. So I want you to think about that. Again, I'm telling you 100% facts. Research what I'm telling you tonight. If you don't believe me, just research it. All right? Even oil companies know that this is not good for them. Oil prices being this high will actually put more pressure on oil companies instead of helping them out. So yes, their profits are going to spike at first, but then their profits are going to die a slow death because people will stop being able to afford all the things that are made with this oil. All right? You go to the store and your bottled water is getting cheaper. You're gonna buy your Brita, ain't you? Am I wrong? Tell me I'm wrong. You go to the grocery store and your bottled water is just getting more and more expensive. You're gonna buy you a Brita or some water filter for your house, ain't you? All right? Either way, one way or another, the demand for that plastic that we have to make that bottle with is going to go down. One way or another, it's going to happen. So what I'm saying is the water company will not need to make as much water bottles or order as much water bottles. So the demand for the plastic goes down, and so the demand for the oil to make the plastic goes down. Right? How about these gas prices at the pump keep staying the way they are? And you and your friends start saying, "Hey, look at here, man, we're gonna carpool to work." All right, hey, you pick me up, and we're gonna both put gas in your car. All right, because it makes no sense both of us paying these prices to go to work. We're going to the same place. All right, you start carpooling your kids. You start, you start taking a few less road trips, so on and so forth. I can just keep going, right? All of a sudden, all these things start to change about your spending habits. And when the things for your spending habits start to change, the economy starts to change. And the economy starts to bleed. And that is going to be worse for crude oil than anything. So crude oil will probably fall below the price they were at before they actually started to bounce. All right? You'll probably catch crude oil in the 50s per barrel, if that's the case. No thanks, Gabriel. We appreciate you though. All right. So like I said, don't be believing your friend with all the conspiracy theories and you know which friend I'm talking about. It's the one that keeps telling you it was a pandemic, that one. You know which one I'm talking about. Okay. All right. You want to learn how economics truly works. All right. So that way you can really understand like the mechanics of how things play out when these things happen. All right. So no, I don't think crude oil was going to last at those prices for a very long time. Okay. So that was the first sign that the stock market probably was going to bounce. The second sign was the undervaluation. Let me go back over here, show you again. Was the undervaluation in our tech stocks, right? Almost 30% undervalued, right? We're talking Nvidia, Apple, Microsoft, all these guys, almost 30% undervalued. All right. So that you got that going on. Then your third sign was when they finally hit the second and third deviation. Meaning, right, they had them one of those interesting days. Right? Meaning we experienced an act of God, right? Giving us them good prices on these stocks. So great. Right? We had good prices yesterday. We have great prices today. And we know it's happening mainly because crude oil prices have spiked. So if crude oil prices are not going to stay up there, Will stock prices stay down here? The answer is no. Oh. Now, here's the other question you want to ask yourself, right? So you got second order thinking right now, which is, okay, cool. We know that stock prices were not likely to stay down there, so I bought stocks and they rallied. After this rally, how long are they going to stay up, though? So we have to, be very mindful of that. Profit taking is going to be key here. Don't be the last person to take profit. Because if you're the last person to take profit, you'll be the first person to take a loss. Hope you heard that one. Don't be the last person to take a profit, because if you're the last person to take a profit, be the first one taking a loss. That I can again, that's another guarantee from me. Okay? So learn to take profits. Because just because prices have bounced off the lows doesn't mean they're going to stay at the highs. I'll say it again. Just because prices have bounced off the lows does not mean they're going to stay at the highs. Welcome to the session. This is how to trade and invest. Just trying to get you acclimated, just trying to get you in line with it. Okay? So we have to be mindful that this whole thing cannot be completely over yet. So we are currently let's go to the SPY right now. We are currently, what's up, Tay? We're about 9% off of the lows right now. All right, so that means by tomorrow we'll probably be hitting 10%. So you got a 10% gain already. So if you was buying down here like I was buying down here, you just might have something that's saying, hey, you know what? Let me go ahead and I'm gonna go ahead and snatch that real quick. Not everything, but the name of the game is to get more cash and more cash flow. I'm not going to be afraid of taking profit because I know, okay, yeah, I gotta pay taxes on that, right? Different times call for different types of work. So in 2021, makes no sense to create these taxable events because the market's in a long-term structural uptrend, and that's going to last until it doesn't, till it's over with. And that moment became when we knew the Fed was about to raise interest rates. All right, later, Aldrin. All right, so once we knew the Fed was going to raise interest rates, we said, okay, cool. Now it's time to take some of that profit. All right, so we waited a while. So but the reality is, at least once every 2 to 3, maybe 3 to 4 years, all right, you're going to end up with a market dropping the way it dropped today. Not today, but the past month. Right? Every 2 to 3 years, maybe 3 to 4 years, right? But let's just say at least once every 4 years, sometimes twice every 4 years. That's a better way to put it. The market's going to drop like it did in March. It doesn't have to be a war. It doesn't have to be a war. It could be so many different things. Okay? Let's go back to 2024. Right, 2025, tariffs. 2024, right here, the Japanese yen. Okay? We can just keep going, right? Seasonal downturns, our regional banks getting hit over the head, just so many different things, right? So at least once every 4 years, sometimes twice every 4 years, you're going to have the market drop the way it did in March. The reason for taking profit is so that way I have more cash to buy when it drops like it did in March. Right? Oh, I can set my little taxes aside, and I'm still going to have more cash. They don't tax you at 100%. Okay? So I'd rather, right, bring some cash into my portfolio, set the tax